Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio since 1977. My publication is available on www.peterdack.com, and I write every day on my ideas on peterdack.blogspot.com. That's my blog. What I would like to talk to you today is about investing in a weak economy. In other words, when the economy is not growing or growing very slowly, what kind of investment you should make. In this presentation, I give you a tremendous amount of information, and hopefully I will prove to you what are the kind of investment, what kind of stocks you should choose when the economy is growing very slowly. I firmly believe that a successful investor has to have an investment process, and my investment process is the following. First of all, I start with what is the business cycle and what kind of growth there is in the business cycle. Then I look at nominal interest rates, that is at the level of interest rates, and then at real interest rates, that is interest rates less inflation. In other words, I check if the interest rates are higher or below than inflation. Then I look at the major trend of the stock market with some indicators. Then I look at interest rates and how they relate to the trend in commodities, interest rates and crude oil and gold, because these are all important asset classes. Then I decide, in this particular case, at the time this presentation is made, which is April 2012, the economy is weak, so what are the stocks for a weak economy? Then how to manage volatility, and then what is the performance and how to use the performance of your portfolio to improve the performance of your portfolio. There is no question that since 1957, yes, the market has moved higher. However, notice how for 12 years, roughly from 1970 to 1982, the market has not done anything, and from 1998 to now, the market has not done anything. There's, of course, has moved sharply higher in the 80s and 90s, mostly due to the influx of baby boomers and their aggressive spending habits. So it is clear that we need to have some type of indicators, some kind of measures to understanding what is the business climate and how it relates to the stock market. I follow the business cycles. I have many videos in my peterdack.com website explaining, in my book, explaining how the business cycle works. But from an investment viewpoint, for the purpose of this presentation, I look at two definite periods in the business cycles. The phases 2 and 3, which is when the business grows above his growth potential or growth average, which right now seems to be around 2.5%. And also periods of slow economic growth below average. And right now, for instance, our work shows that we are in phase 4, trying to get into phase 1, but we are mostly stuck in these periods here, with the economy growing very slowly and not capable of improving. There is nothing magic about the business cycle. It's how business drives the conditions, stronger growth or slower growth, human decisions. But from an investment viewpoint, what is important is to recognize, are we growing above or below average? Because growth drives profits and asset prices. Of course, if growth is strong, then you have commodities rising, hard assets rising, interest rates rising, and sometimes, more often than not, stock prices rising. So it's important to understand or to recognize, are we growing above or below potential? There are several leading indicators that are telling you which way the economy is growing. I will point to you some of them, and that is important. But the most important thing is, keep in mind that the long-term growth of the economy is given by productivity growth, which right now, as of April 2012, is close to 0, plus population growth. So if population grows at 1% and productivity is close to zero, you know that the economy is not going to be exuberant at all. As this presentation is made, the economy is definitely in phase 4, and you recognize the conditions and what's happening in phase 4. The Fed is easing aggressively because she's trying to stimulate the economy. Commodities are declining because there is lack of demand. Yields are also declining because, again, inflation is coming down and therefore yields decline. Short-term rates, of course, are low because the Fed is easing. Financial risk is declining because the Fed is adding liquidities and a lot of money into the economy. And as I said, during phase 4, inflation is declining. So since we are in phase 4, how do we invest in times of slow economic conditions? The first thing I do whenever I start my investment strategy is to look at the level and trend of interest rates, especially real interest rates. That is a relationship between short-term interest rates and inflation. I'll tell you why it's very, very crucial. Notice how the red line is short-term interest rates and the blue line is inflation. Notice how there has been 3 basic periods since 1974. The first period goes up to 1982 when short-term rates were below inflation. Then beginning in 1982, short-term rates were consistently above inflation until 2001. Then beginning in 2001, short-term interest rates have been mostly below the rate of inflation. Again, remember these 3 dates. Up to 1982, real interest rates were below inflation. From 1982 to 2002, interest rates were above inflation, and then beginning 2001, 2002, interest rates below inflation. Let's see now what is the impact of these trends on commodities. This is the chart of commodity prices, a commodity index CRB, which is raw material industrials, and this excludes oil and gold. Notice how commodities rose at a positive rising trend until 1982. Then interest rates were above inflation and commodities didn't do anything. They're absolutely flat until 2001. In 2001, commodities, short-term interest rates went below inflation, money was cheap, and commodities rose. So the bottom line is, if real interest rates are below inflation, the trend of commodity is up. However, notice that there are these wiggles going down, going down, going down, going down. If the economy slows down, then commodities tend to decline. If the economy accelerates and strengthens, then commodities rise. Right now, here as of April 2012, the economy is weakening, and as you can see, commodities have been declining. This is very important to understand. So this two relationship with real interest rates and the business cycle and commodities when you want to develop a sound investment strategy. This is the chart of the CRB, the commodity index. This one includes oil and gold. Notice how beginning in early 2011, actually it's around February, March of 2011, the CRB index has been heading lower. Why? Because the economy has been slowing down. This is the blue line is the 150-day moving average, which is an important trend line and gives you a sense of what the direction of the market is. Anyway, the point is that as the economy slows down, commodities have coming down. This is the price of gold, and the point I would like to make is that, again, this is the 150-day moving average. As you can see, has a nice upward trend, and the price of gold stays above. But beginning in the middle of 2011, even the price of gold started declining, responding to the weakness of the economy. My view is that gold is a commodity, so you should treat it, in my view, as a commodity. An interesting pattern here of gold is that every time you see a strong volume after a rally, strong volume after a rally, strong volume after a rally, the price of gold peaks. And the higher the volume, the more important is the peak. Here again, high volume is a peak. So beware of rising volume after a rally. Here I'm showing the price of crude oil. And again, crude oil is behaving exactly like all the other commodities. Again, this is the theme that I would like to come across with, is that all commodities behave in the same way. Notice how oil peaked in the early part of 2011 and really has not done anything since then. Why? Because the economy is gradually slowing down, and in fact is even slowing down even more in the first half of 2012. What is the point of the previous slides? Well, the point is clear. Commodity-sensitive asset classes perform well during periods of low real interest rates and strong economy. In other words, low real interest rates means when interest rates are below the inflation rate. And also commodity-sensitive stocks, they decline sharply in phase 4 when the economy grows below potential. So these asset classes should be avoided in times like the current one. Again, we are talking about April 2012 when the economy is slowing down. Managing risk. From what I said before, it's clear that I firmly believe that one should look at real interest rates and the level of interest rates relative to inflation. In a strong economy, commodity-sensitive investments are definitely the best performing ones. In a weak economy, however, then commodity-sensitive stocks should be avoided. And then another concept that I think is very important, but few people remember, that all commodities move in the same direction. It's very difficult to find, for instance, that copper goes down and crude oil goes up, or gold goes down and crude oil goes up. The general trend is always the same. What is the direction of the stock market? A simple indicator is the unemployment claims. Here the red line is the S&P 500 and the blue line is unemployment claims. This is a 4-week moving average. And again, notice how that when unemployment claims decline, the stock market rises. When unemployment claims rise, the stock market is weak. Why? Because when unemployment claims decline, that means the economy is strong, profitability is going to improve, and of course this is what the stock market strives on. In 2012, unemployment claims declined, and of course the market went up. So this is a useful measure to follow. We have, at Peter Daggett and Associates, have developed several indicators measuring financial risk. And this measure the tightness of the financial markets. And one thing that this chart shows is that every time the financial risk declines, the stock market rises. When financial risk increases, the market declines. Here the financial risk has been declining and the stock market has been rising. So financial risk is one of our major, most important indicators that we follow to understand what the direction of the market is. What I would like to show you now is the next slides is how commodity sensitive stocks behave relative to the business cycle. This is Caterpillar, CAT, and notice how the price of Caterpillar declines here, and again declines in the first part of 2012. Why? Because in each period commodities decline, and of course Caterpillar depends a lot on the trends in commodity prices and mining, and therefore the price of the stock doesn't perform well here, here, and here. This is another example of commodity sensitive stocks, and this is potash. And as you can see here, the economy slows down, the same behavior as Caterpillar, and the stock didn't do anything. Here again, this was a recession, commodities decline and the stock declined. And here again in 2012, the economy started slowing down, commodities declining, and the stock of potash did not do well because it is dependent on the price of commodities, and of course commodities going down, profit margins get squeezed. This is another commodity sensitive stocks, in other words a stock that depends on the price of a commodities, copper and gold. And again, notice how in early in 2011 the price of commodities started heading lower, and look what happened to the price of the stock. Clearly now you're beginning to sense the pattern. You cannot invest in commodity sensitive stocks when the economy weakens. The reason is that when the economy weakens, commodities declines, and therefore profitability of all these companies really suffers. This is the price of Marathon Oil, which is oil dependent. Again, the pattern is still the same. I know it is almost boring, but that's the point I'm trying to make, that at the beginning of 2011, commodities declined, the economy was weaker, then it improved again, but then there was a relapse in 2012 of economic growth, and look what happened to the stocks. It all follows exactly the trend of commodities. Again, the point being that even crude oil is dependent on the growth of the economy. Another stock that is dependent on the price of crude oil is ConocoPhillips. And again, exactly the same pattern of Marathon Oil. Look how it peaked in the first half of 2011, like all the other commodities. And then again, here there was a weakness again in the first half of 2012 as commodities declined. Caterpillar is another stock which company depends on the trend of commodities, and again this is the 250-day moving average, and notice again how commodities peaked in early 2011 and then again in the first half of 2012, and Caterpillar stocks went down and then moved higher, went down again because of the weakness in commodities here and here, but overall has not done anything for more than a year. BTU is an energy company, and the pattern again is the same. Commodities peaked in early 2011, and sure enough, this company, the stock, did not do anything for more than a year. So this is the trend. The economy is slowing down, commodities weakening, commodity sensitive stocks of any type don't perform well. Of course, then the question is, okay, if in a slow economy one investors cannot invest in commodity sensitive stocks because commodities decline, what kind of stocks one should invest? Well, for commodity, during periods of slow economic growth, one has to invest in conservative investment with sound and high yields, like for instance Altria, and look at the 150-day moving average and look at the price of the stocks, which is totally independent of what commodities do. So again, the point is that when the economy slows down, the investment strategy has to be totally different from the strategy when the economy is strong. Another stock doing well when the economy is slow, as in slowing down, as in on April 2012, is Dollar Tree. Again, look at the 150-day moving average and look at the price of the stocks. Now compare the action of these stocks with the ones I showed you before, and it's definitely there is a totally different picture. Another sector that does well when the economy is weak because interest rates are low is the REITs. They offer high dividends, and of course that gives them opportunity with low interest rates. It gives opportunity to company to go out and buy attractive real estate. Again, here the same picture. Look at the 150-day moving average going steadily high, and look at the price of the stock staying steadily above the 150-day moving average. Low volatility, excellent investment in the last 3-4 years. Most people believe that bonds are not an attractive investment. I have videos on why bonds are an attractive investment for capital gains, not necessarily for income. And again, if you look at this video, I'll show you why the capital appreciation could be significant even at low level of interest rates. And the other point is that interest rates do not rise when the economy is weak. Interest rates is the price of money, and like all prices, when the economy is weak, they tend to decline. But again, the message here is bonds are an attractive investment for capital appreciation. Another asset class doing well when the economy slows down is corporate bonds. Again, the picture is almost the same as the previous stocks, which were belonging, by the way, in different sectors. But look at here, the same 150-day moving average, and look at the bond price moving higher. Again, you buy bonds not just for the yield, but you buy because the price of the bond moves higher. And again, this is an attractive investment when the economy slows down. This is the price of the S&P 500 in the last 3 years. Again, this is the 150-day moving average, and of course, as you notice, there is considerable volatility because this is an average. But between the S&P 500 stocks, when the economy is weak, you will find discretionary staples and REITs and bonds having much less volatility than the S&P 500, while instead commodity sensitive stocks have much higher volatility. From what I said before, the message is clear. You have to be very specific in your investments if you want to manage your risk. And in a weak economy, essentially buy defensive or the stocks that do well, sectors that do well in a weak economy. They are discretionary staples and real estate. In a strong economy, you want to be in stocks and sectors that appreciate the most, and those are those as associated with commodities. How do you manage risk and the volatility of your portfolio? Well, you have to select low volatility stocks. They will outperform the market during bear markets or periods of market weaknesses. They make, and this is the most important thing, the low volatile stocks make your returns more reliable, and especially focus on those sectors that are going to perform the best at that particular phase of the business cycle. In order to recognize near-term risk, Peter Daggett and Associates has developed timing models that give a sense of where risk is and if the market is overbought or oversold. And as you can see from these indicators, when the indicators are high here, you might find a market correction, and when instead these indicators are low, then you have a rising market. Here, for instance, in around March, April 2012, the two indicators are low, indicating there is a correction shaping up, but these two indicators are failing to rise, and you notice that when they rise, they indicate more market strength. In this case, it's not happening. So the time to still remain cautious at that time. Another interesting indicator is the VIX, or volatility. The way this is used, that when the the VIX declines, like here, then the market is likely to rise. But when VIX rises, then the market corrects. The trigger point is 20. If, as long as the VIX rises above 20 and stays above 20, then the odds are the market is not going to do much. However, when the VIX starts declining, then you know the market is setting up a base to rise, and then eventually here will start going up. Again, here the same story. When the VIX rises, the market corrects. Here exactly the same thing. The VIX here during this period, the market was okay, but as soon as the VIX rose above and stayed above 20, the market corrects and was weak. As soon as the VIX declined, then the market picked up and started rising. There are other ways of measuring risk in the market. For instance, one thing that I personally like is the trend line. But the trend line, to be useful, has to span several months. In this case, 1, 2, 3, 4.5 months. Once the trend line spans many, many months and the market breaks below the trend line, means that there is a significant change in the momentum of the market, and one has to be careful. Other important information is support levels. Again, here would be a support level around 1350 is an important level to watch. And of course, if the market falls below 1350, then the next support level is this one, which is around 1275, which would be a 10% decline from the peak of in March. So these are all tools no one is perfect, but these are all tools to keep you alert on where risk is going and in which direction. Timing. Timing is a way to, it's not really the answer, but it helps to recognize the risk. So to have tools that tell you how risk is high or low and where the opportunities are is a useful tool in your investment process. The other concept that we discussed is select low volatility investment. Using the 150-day moving average as a criteria of trend and momentum is always a good tool, is a solid tool. I have a video on timing ETFs, and it gives you an idea of how to use, in a simple way, the 150-day moving average and timing your portfolio. That might give you some ideas. So what is the investment process and how to manage risk? Well, the basic concept are: you look at the business cycle, establish if we are in a strong or slow growth, look at real short-term interest rates. Are interest rates below inflation or not? Decide which asset classes and stocks you want to be depending on where the business cycle is. Use 150-day moving average and timing models to understand where risk is high or low. And above all, measure your performance, understanding how your portfolio is growing and what is the strength, what are the strengths or weaknesses of your portfolio. It tells you where you should focus your attention. Should reduce the investments in the weakest position and emphasize the areas where your portfolio is strong. So listen to your portfolio, and above all, after this analysis, don't think about it. Just slowly, small steps, but take corrective actions right away. Otherwise, you're going to find that if the market declines, you will have some losses that you won't like. I guess you will find that what is interesting about what I've been talking about, that everything is connected. The business cycle drives short-term interest rates and inflation. Of course, that depends, and inflation has an impact on bond prices, and the way that the economy is strong or weak, you have commodities going up or declining. Of course, depending on the phase of the business cycle, you decide which sectors you want to be. And of course, recognizing that if you're making money or not depends if your strategy has been correct. And notice how all these things are all connected between themselves. So if something doesn't work because obviously something in your decision-making process, somehow you missed a point in one of these items. The following are off-the-cuff thoughts that I had in my 30-plus year of experience in this business. Momentum is one of the strategies that works. And why? Because it reflects changes in the economy, changes in the management of a company, changes in the market, and these changes last not for just 1 or 2 or 3 days, but last for months and months and months. So these changes last for a long time. But of course, you have to watch if there is a loss of momentum, which is why the 150-day moving average is not the solution, but gives you an idea. Another way of showing is what I call the horse race, which means compare always the stocks that you have in your portfolio relatively to each other. It's like in a horse race. Try to find which ones are leading the pack and which ones are following. And of course, you have to reduce the exposure to the ones that they don't seem to appreciate as fast. I think one of the most important part in portfolio management and risk management is to listen to your portfolio. What is your portfolio telling you? One thing that I found is that too much diversification is not a good idea because it's difficult to find what you're doing right and what you're doing wrong. Besides, the economic times are so distinct, strong growth, weak growth, that you cannot have many different sectors. They only have to be specific and invest in very few positions. And focus on specific strategy sectors, like I suggested in 2012 in April. The economy is slowing down, then emphasize defensive stocks. Another thing that I found is brokers are not money managers. They are advising you to select the best investment, but the ultimate responsibility of the portfolio is yours. I'm saying this because sometimes I find clients that are disappointed with a broker. That's again, it's caused by the misunderstanding of the function of a broker, not because the broker is good or bad. Measure your performance. This is very, very important. Understand why you're making money and which sectors do make money for you. And don't think about which stocks are doing well or poorly, but the important thing is if overall portfolio is doing okay and achieves the kind of results you were expecting. And another thing is always have a flexible investment strategy. If you see that something is wrong, don't sit on your hands, just do something. What happens when you sell because your timing tools tell you to raise cash? Well, one technique is to use SH. SH invest in the opposite of the S&P 500. So the S&P 500 goes down, SH goes up. So some of the cash can be used to offset the probable losses in your portfolio if you think that the market is going down. Can we learn from history? My answer is no. No one knows the outcome of political, social, and economic decision. History is random. I know this is a fancy concept, but is random. This is the reason why we seem to repeat the same mistakes, because the forces at work cannot give you enough information to predict what is happening. The problems in Europe, you know Europe is probably going to dismantle, but you don't know why. That's the randomness of history. And then there is the fallacy of utopia. Some people are telling you about believing in hope, believing in courage, believing in this, believing in that, and believing in the workers' paradise. These are all utopias, but when the time comes to implement them, there are so many regulations that eventually create some difficulties for the economy and for the people who believe in those utopias. What amazes me is that they should know. Think about all the PhDs, all the Nobel Prizes, all the experts in Washington, the best brain in the world are there. Yet this century has been plastered with depressions in the 30s, recession and inflationary periods in the 70s, wars from 1910 to 2010, one after the other, and then amazing bubbles of all types in 2000s. So how come we keep having all these problems if they are so smart? This is why this is an important concept when you decide and you plan your investment strategy. Well, I wanted to thank you very much for following this presentation. And again, there is much more information and videos on www.peterdag.com or on my blog, peterdag.blogspot.com. Again, thank you very much. I really appreciate it, and have a wonderful time. Thank you. Bye-bye.